Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we're breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. It's a mixed day on Wall Street today, but earlier a tech sell-off helped drag down stocks, kicking off a week filled, we know, with big tech companies reporting their earnings results. Investors also watching the White House for news around tariffs. And despite tariff turmoil, consumers, they are still opening their wallets and spending money. We're taking a look at how long this trend could continue. And Nvidia in the hot seat, its stock sliding on news that Chinese company Huawei is reportedly making a rival AI chip. Nvidia has lost a fifth of its value since the start of the year. We're going to discuss what this competition might mean for the company going forward. Well, Bank of America out with a new report on the consumer, and while spending remains strong, it could be fading after the buy-ahead trend in light of tariffs. For more, we're going to be bringing in here David Tinsley, senior economist at the Bank of America Institute. David, it is great to have you on the show. So let's talk about the American consumer, David, our friends and neighbors, and how much they're spending, where they're spending. You say here April showers have not dampened spending yet. Walk us through the data, David. What are you seeing?
Yeah, great to be here, Josh. So what we're seeing is that consumer spending still had forward momentum over the first sort of 3 months of this year. When we look at our 69 million Bank of America customers, we still see them spending on credit and debit cards and increasing that spending. And then as we get into April, so this post these tariff announcements, obviously it's at a time when consumers are less confident. They have still been spending. So in the first 3 weeks of April, the 7 days to April the 19th, spending on credit and debit cards in our data was up 3.1%. So still spending, I think.
So one tricky question here, David, for economists like yourself is, as they're spending, how much of that do you think, David, is that they are buying ahead of potential tariff impact?
Yeah, I mean, I think this is a great point. So basically, when you look at when we pass our data and we look at particular consumer durables, so we're thinking their electronics, furniture, building materials, we did see a ramp in March and into April. And I think particularly two areas, I think in particular, likely in that. One's electronics and the other is autos. So separately, when we look at our auto loan applications data, what we saw is that in the last week of March and the first 3 weeks of April, a jump in the year-on-year growth rate to around 20% or so in those loan applications. So people were particularly, I think, energized to try and get ahead of the car tariffs that were coming in.
Any evidence, David, you see the data so far that would suggest that spending has been impacted at all by the stock market sell-off?
Good question. No, not really. So you've got to remember, of course, assets, wealth, very skewed in the economy. The top 20% of households by income, they own around 80% of directly held equities, so those outside of retirement accounts. When we look at that data and we look at the higher income cohorts, those people are above sort of top 30% and then into the top 5%, right at the top, their spending growth pretty much bang in line with everyone else's, if anything, a shade more positive. So no sign yet that they're pulling back. I think those wealth effects, as economists call them, come through with kind of quite long and variable lags, in essence. We might see that over coming months. We'll certainly be looking carefully. But right now, not much sign.
You know, often when we talk about the American consumer, we talk about it like it's one consumer, but of course there's many, right? There's high income, like you just mentioned, middle, low income. Are there meaningful differences that you're picking up in the data between those three in terms of their overall health and resilience right now?
Well, what's I think really interesting is that we also track the wages, the paychecks going into people's accounts. And what we saw in March was the lower income households, the bottom third of households, their after-tax wages growth had slowed to the weakest rate of growth since, I think, 2017. And that's not the case for middle or higher income households. So I think there is, I think, a concern that slowing wage growth at the bottom end, and of course some cost pressures, indeed some of those being added to in a sense by tariffs and higher import prices. I think that lower income consumer is weathering some storms somewhat. Okay, they're keeping their heads above water right now, but I think the pressures have intensified.
Final question, David. We talk about the consumer, of course. A lot depends on the resilience of the labor market. The labor market has been resilient. We do have that big jobs report this week. Just curious, as an economist, David, what do you expect there? What do you expect for the labor market overall throughout 2025? How do you see it evolving?
Well, I think you're exactly right. I mean, the labor market is key. It's been key in our data to keep a very strong consumer picture over the last few years. And I think in some respects, the kind of a potential slowdown in the consumer does run through a slowdown in the labor market. So, we'll look very closely at that data and jobs data, job openings data this week as well, that you were talking about in your report earlier. I think those things are key. For now, I mean, we're sort of fairly optimistic that the data will hold in there, but I think, it does require very careful thought and observation.
David, great to have you on the show today. Thanks so much for your time.
Thank you.
Stick around, much more Ask for a Trend still to come. The Dow and the S&P 500 rise for a fifth straight day in the lead up to big tech earnings this week. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Jared.
Thank you, Josh. We got to start with the major indices, stocks, and that's the major indices. They have reached the Rubicon. That is a decision point. Things could turn up in favor of the bulls, and they've been going up, to be fair, as you said, for 5 days, or they could turn back down. So let me show you what I'm looking at in the S&P 500, and it looks very similar in the NASDAQ 100, and the Dow. So I'll just do the S&P 500. This is a 2-month chart, and what I want to show you is you can see we kind of fell off the cliff right in here. I'm going to draw a horizontal line. This is the cliff line, and you can see after we dropped here, we had that magnificent day. The NASDAQ was up 10% or 12%. S&P 500 was up 10% that day, but then it stopped. And then it kind of fell off a bit, and then it has retested. So my point is there's a lot of price memory in here. A lot of investors who were buying the dip in here from the prior highs from earlier in the year, those investors might want to get out at break even. And so that kind of dynamic in the market creates a situation where if we don't have another bullish catalyst, a lot of times the market will just roll back over. So the market really needs to climb above this level right here, which is above 5,700. And then to the downside, I'd really like to see 5,500 hold. I'm not saying the floor falls out again if we go below it, but 5,500 is a really good level to watch here. And I'll tell you another thing. I said the NASDAQ was pretty similar. I'll just put that up here. And indeed, it is a very similar picture, Josh. And let me just add this. Last week, we had a lot of bullish developments. We were talking with Ryan Dietrich. You were about those the breadth thrust that we got, those weak breadth thrust. Investors Business Daily has their own similar indicator called a follow-through day. That signal that has to do with the major indices. So the elements are here for a nice rally continuation, but we've got some headwinds.
How do earnings play into this picture?
Good question. That brings us to point number 2. What about earnings? What about that E? Let me show you, because earnings estimates for 2025, this is a full year, those have been coming down. And I have a chart from Bank of America. So the white line here is 2025. We actually start projecting what's going to happen with those earnings way back in December of 2023. So that's why it starts all the way back here. And you can see it was rising, and now it is kind of falling a bit. The blue and green lines are historical averages. The green line is basically everything every year going back to the beginning of the century. And then the blue line, it takes out a number of the crises. It takes out COVID, it takes out the great financial crisis, takes out Y2K, which was a dot-com bust. So we are right at the decision point right here for earnings. We could hold on to some of these earnings estimates. However, Bank of America thinks that we track this this historical average down here that includes some of these COVID disasters, the global financial crisis, et cetera. So Bank of America is saying that we're probably going to follow this more negative track. We'll have to see how it turns out. Oh, I did want to add another thing. I did get to talk to Emily Rowland. She's a chief co-chief investment officer over at Manulife John Hancock Bank. And we were talking about earnings, and specifically the earnings, the E in earnings in that PE ratio, how it's been coming down. Here's what she had to say.
The challenge is nobody really knows right now what the E is. So stocks have gotten cheaper. On the PE ratio, there's a lot of uncertainty around what is the earnings estimate right now. So yes, prices have come down, but stocks may not be as cheap as they look because that E, the earnings, probably has to adjust lower.
So the big question is, do earnings adjust lower down here, or do we ride this historical track absent these crises?
Finally, Bitcoin.
Yes.
You look at the charts. What do you think? Is the worst over? What do you see?
I'll tell you what, Bitcoin is looking a lot like US stocks. Not exactly, but I want to show you the chart and then you'll kind of see what I mean. So that was the NASDAQ. That's what we left off on. I'm going to show you Bitcoin here. I'll put some candlesticks and I'll show you since the beginning of the year to date. There we go. Now, Bitcoin fell off a cliff in February, and so not exactly like equities, but you can see what happened. It rallied right up to the prior breakdown point, and then it sold off, and now it's reached it again, and here we have another decision point. So my point is, Bitcoin is kind of mimicking what's going on in US stocks. It's echoing it, not perfect, but another decision to be made. And you might think, well, Jared, didn't you say it was going down to 72,000? It hit 74,000, and that might have been the low. So all in all, we have a number of markets that are looking very similar, and a decision needs to be made, but we need that catalyst. Is it going to go up or down?
All right. Thank you, Jared. Appreciate it, buddy. Meanwhile, Nvidia under pressure as China's Huawei reportedly readies an AI chip after Trump's export ban. For more on what this means for the AI race between the U.S. and China, let's get right to Yahoo Finance's Dan Howley. Dan.
Yeah, that's right. Nvidia kind of on its heels here when it comes to China, although we'll give a little caveat there in a second. Huawei reportedly working on a new chip called the Ascend 910D. It's the follow-up to the Ascend 910B and C. This is according to the Wall Street Journal. The chip is supposedly supposed to be more advanced than NVIDIA's H100. Now, the H100, not exactly NVIDIA's latest and greatest chip, a few years old at this point. That's from the Hopper generation. They're currently in Blackwell, and they already announced Blackwell Ultra, and then the chips after that. The important thing here, though, is that it proves that Huawei, if these estimates are correct and that it actually does surpass the H100, it would prove that Huawei is pushing forward with their own capabilities without the help of U.S. technologies like NVIDIA's. And so the caveat being here that NVIDIA really doesn't sell much in China and can't sell much in China anymore now that the White House has basically said, look, the H20 that you built specifically for the Chinese market, it's going to be under export restrictions. And so more or less it's banned from being sold. China did make up a good chunk of revenue for NVIDIA in its prior quarter, and now they're saying they're going to have to pay back $5.5 billion as far as charges go related to some of the chips that they were expected to ship out to the country. But this chip is important for Huawei, but it doesn't say that the NVIDIA is falling behind. It's showing that there's another alternative available to Chinese market customers. And so this kind of back and forth between the U.S. over which is going to win the AI wars kind of continues on now. The U.S. was trying to push China away, kind of leaving them in the dark as far as the technologies go, so that the U.S. could maintain its stance as the number one AI power, but China clearly showing that it's not going to kind of sit back and let that happen.
Here's a broader policy question for you, my friend, which is, so the Chinese government would obviously like to be a global tech powerhouse. The U.S. government would prefer they not be. And so we impose these export controls, which some believe, listen, the CCP is an adversary and we've got to try to move these levers. Others argue what it's doing, perhaps, is encouraging Chinese companies like the Huawei's to get more creative, to get more dynamic and innovative. I'm just curious your thoughts on that.
Yeah, that seems to be the takeaway that has kind of become the go-to since we'd seen DeepSeek's R1 and V3 models that were developed using NVIDIA's earlier technology, the H20s. Those chips are not top of the line, but they managed to produce models that were up there with what OpenAI has to offer, built using the latest and greatest. So it really is a matter of, okay, they're going to find a way. The researchers in China, that they're, obviously they're motivated to make, the latest and greatest models as well, prove that they can be as much of a powerhouse in AI as the U.S. And that appears to be exactly what they're doing. And regardless of what the U.S. Tries to do with stopping different types of technologies from flowing there, it seems to be that China will do what it has to do to be an AI powerhouse.
Dan, great to see you. Thank you, my friend. Stick around. Much more Ask for a Trend still to come. Well, for the past couple of years, the Magnificent Seven have dominated earnings season, but the scene may be shifting in years to come. Yahoo Finance's Julie Hyman joins me now with a closer look in our chart of the day. Julie.
Indeed, Magnificent Seven and their earnings growth has really propelled earnings growth overall for the market, for the S&P 500 specifically. This chart comes to us via Lori Calvasina of RBC, the chief equity strategist there. So here, let's just look at the entire S&P 500 and the trajectory of earnings growth that we've seen over the past few years. 2023, 24, what's expected for 25, 26, and 27. So a little choppy here, particularly this dip that we're expecting to see this year before coming back, but kind of steady, averaging around 10% or so. Then we just look at the Magnificent Seven specifically, whose growth far surpassed that of the rest of the S&P 500 for the last couple of years. This year, it's really expected to decelerate and remain that way for the next couple of years. Part of this is it's just difficult to maintain that pace of earnings growth, especially since at least some of this came from Nvidia, which was seeing leaps in year-over-year gains as we were really seeing the beginning of the AI trend start to take hold. And then finally, we have the other 493, the S&P 500, excluding the Magnificent Seven. What's notable here is that after we saw, again, sort of choppy growth over the last couple of years, we're expected to see a little bit of an upward gain before stabilization in 2027. And this is what we've been hearing from a lot of strategists, this idea that as the Magnificent Seven slows down in terms of its earnings growth, that the other companies will start to pick up. We heard that most recently from Ryan Dietrich of Carson Group at the top of the show.
We know this time 2 years ago and last year was all about Mag 7. That's where most of the growth and earnings growth were coming from. But it has been, broadening out, I guess is what I want to say. Now with the market acting the way it's been, it's a little different, but we think a broadening out still makes sense.
And that's what's so interesting here, Josh, is that even amidst all of the tariff uncertainties and all of this going on, that these types of earnings estimates have largely held intact. In other words, that big idea that the Mag 7 are going to slow a little bit and everything else is going to accelerate a little bit.
All right, thank you, Julie. All right, let's take a look now at what's trending here in the after hours, checking in on shares of NXP Semiconductors cloud management company F5 and Nucor Corporation. NXP Semi topping first quarter earnings expectations. The company noting guidance for the second quarter underpins its cautious optimism on navigating a challenging set of market conditions. NXP also announcing a management transition. CEO Kurt Sievers planned to retire by the end of 2025. F5 beating earnings and revenue estimates for the second quarter. Looking ahead, the company providing a better than expected third quarter revenue outlook and upbeat profit guidance. F5 highlighting its outlook is driven by a substantial subscription software renewal base and continued strong systems demand. And steelmaker Nucor sees its largest earnings increase in the steel mills segment. Nucor beat the average analyst estimate with net sales of $7.83 billion. And the company is also expecting second quarter earnings to increase, with the CEO saying, quote, despite recent financial market volatility, Nucor is seeing solid demand for the steel and steel products we manufacture. Well, that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.